This is the VIX index. VIX is just, this is a volatility index. So generally when VIX is above, I'd say 15 to 18, the IPO markets are closed because you can't have stability of liquidity in the markets. As you can see in the last year, it's gone from like 25 up to like 30 something, which is super high. And now it's traded down to below 13, which is signaling that if this continues, that the IPO market should open at some point.
Yeah, back to 15 to 18, right? So when
yeah, if it continues to trade down, it means the equity IPO markets, and also debt also has kind of like an IPO market in a way. But those markets were open, and which means that then there's more capital flooding into the markets, which then has a cascading effect on other sources of funding as well, because then you have like an exit opportunity, like another exit venue. A lot of the tech companies that have been funded in the last few years, like right now, they can just be bought by big companies and corporates.
Yep.
We're also in cash conservation mode. So it's like, they have one channel, and then those companies they're looking very strategically at assets. It's not to say that, I think there's going to be a lot of M&A activity, more so than we've seen in the last couple of years in the coming years. But it just means they only have one exit avenue. When equity markets open, the IPO markets open, they have another avenue. So that also then generally creates like a domino effect on the rest of the ecosystem.
When we get profitable,
yeah,
we can choose how to get, how we can get funding,